Hello everyone, and thank you. I think you picked the right one, so you did the right choice to stay with us. So it's the last, I would say, product session about alternative credit. I'm Emmanuel Isanchou. I'm Global Head of Credit Markets at Natixis, and I have with me the pleasure and the honor to have prominent investors in the alternative credit space. So we have Deborah Shire here, Deputy Head of AXA IM Alts, and Global Head of Structured Finance and Impact Private Equity at AXA. We have Munar Shafi, Head of Structured and Private Debt at Aviva Investors, and Niels Bodheim, that you already saw at with Patrick, Head of Alternative Credit at NNIP. So what we want to do really right now, it's kind of deep dive a bit more in the alternative credit space. We touch upon really like private assets. It has been mentioned at the last panel, on the investment panel, alternative credit for a little short period of time. This is clearly an area that grew steadily and exponentially years over years. When you read, different literature, you can see that the alternative credit space maybe tops $1 trillion. But when you read about it, nobody really knows what is alternative credit. So I guess my first question to all of you, and starting with you, Deborah, is how do you define and how do you qualify what is alternative credit in your company?
Thank you, Emmanuel. So in our organization, we manage 188 billion in real assets and alternative credit, and basically roughly half of that, 88 billion, is what we consider being alternative credit and private debt. So, to echo what was said this morning, for us, it covers all the arenas that were discussed this morning in terms of private debt, but we also add the structured finance, so some part of the public market. And we believe, and I'm sure we will cover that there is a logic in having the ability to basically allocate between public and private in those different asset classes, so to have a broad perspective.
Thank you, Deborah. Niels?
Yeah, I answered part of it this morning, but we're the same. We call it alternative credit instead of private debt because we have the ABS component added to our solutions. Maybe to not repeat what I said this morning, perhaps taking it from an investor perspective and more on the allocation. So what does private debt mean to the portfolio? A lot of what we do at NNIP is investment grade, and so we are effectively a fixed income replacement, but private debt or alternative credit is much more than that. It can also be looked at as a replacement on the equity side, so it just depends on your risk-return profile. I had the benefit of working in investment consultancy for a number of years. A lot of what we service today is institutional capital out of Europe, but had investors from Australia to Canada and everything in between, and yes, each investor has its own definition of alternative credit, but the importance is how does it fit into the portfolio? And as long as you're okay with a buy and hold position, I think that's critical. But for us, alternative credit is really a fixed income replacement given its IG quality.
Thank you, Niels. Munawir?
Hi, everyone. I actually quite like Benjamin's definition of private and alternative credit. Anything that is not on Bloomberg is private. But I think it's more complex than that. I personally think it is the style of investment. For ease, we call it a new asset class. But really, if you look at private credit or alternative credit, you have underlying risk drivers which are not too different from assets on the public side that we are used to. People call mid-market loans as private. You have alternatives in the form of high-yield bonds or corporate bonds, that are also investable universe. Infrastructure, pre-global financial crisis, which looks like a long time in history, you had infrastructure bonds. In UK, project finance, which has now become a complete private market, you had public bonds, 2005-8 issuances. So is it a new asset class? No, in my view. And this is how we as an organization look at private credit. We think when it comes to risk drivers, they are very similar risk drivers to public markets. But when it comes to origination, sourcing of the assets, that's when things are completely different. You don't have the benefit of having a rating. You don't have the benefit of having a transparency in pricing. So how do you go about sourcing, structuring, assessing credit risk. That's what is different to public markets. Yeah.
Thank you very much. And actually, it leads me to a comment and questions that I'll have to be a bit controversial. Clearly, when we talk to investors, and I talk to investors in the US and more recently as well in Europe, effectively say all that is good, but when the market dislocates, and we touch upon this in the investor panel, the public market dislocates, you got rates going up, you got credit spread going up, and then, as you said, Deborah, and Niels, it's a question of like being able to do a bit of public and private and to have the right allocation. But the question is, what is the real value of alternative credit right now, and I mean alternative credit, in this current market? Do you see the same interest from investors to deploy in specific areas, and if you can be specifics around, let's say, consumer finance, mortgage, structured credit, like reg cap, fund finance? What is the benefit in this current market, especially when, you know, we say, well, we are buy and hold, but buy and hold doesn't mean that you don't need to value your investment. And there is a lot of things regarding it's illiquid, it's fine, it's buy and hold. But there is difference between like a buy and hold and be just with like and praying that at the end of the day, I'll get par plus my return. So how do you see in this market the value of sourcing alternative credit? Maybe Deborah, if you can enlighten us.
A lot of questions in one question.
Yes, always.
We heard it this morning, and I think all of us, we are obviously challenged by the current ladder of relative value between the public and the private today, and more than that, across the different asset classes. Our strong belief is that you can't ignore that. So you can't just say, and there are technical reasons for that. So there are definitely a lot of imbalance between the demand and offer that create an opportunity of flows in the private debt market, not to tighten as much, widen as much as what we have seen in the public market, and probably, except for difficult credit, this will lag some time. Having said that, I think we can add probably a couple of elements. First, some asset classes have started to reprice. And specifically, if I have in mind, for example, mortgages in some countries in Europe, we have seen them because they provided long duration. I mean, and because, sorry, I am at a conference from a bank, but because you don't have a natural appetite for the banks to smooth that, you have seen the adaptation of the prices in Dutch mortgages. So some of the asset classes are adapting, and we do believe that they can be very interesting to be considered today. Some asset classes will take more time. Does it mean that they don't have a place in the portfolio? You mentioned regulatory capital and asset classes that are more niche. Our strong belief that we like those asset classes because they provide a lot of stability and diversification. Patrick told us this morning that one thing was for sure, or maybe I listened not so carefully, but I heard in his conclusion that one thing was for sure. It was about the volatility in the market that is to come. When you are an insurance company, obviously volatility kills you twice in your solvency, because I mean the volatility is exact amount of capital you have to add day one. So having the ability to avoid volatility, not because assets are not properly valued, but because the fundamental default rate of those assets is still stable, is something that we value a lot. And finally, as I said, diversification. I mentioned reg cap, maybe we'll dig into that. You can access in those kind of asset classes type of underlying credit that you will never see in the disintermediation markets because they are too small or because they are of a too good quality to be disintermediated. In both cases, we do believe that those are probably asset classes that will be like very resilient in whatever is coming, ability to provide a true diversification in portfolio, and again, this is why we do still see value there, even though throughout cycles, because they are compared to bank capital cost, you will never see those assets at 20% yield, despite what could happen on the public markets.
But that is very interesting. You mentioned one point with regard to disintermediation, and I will tie to that to actually scalability, because it's not like we see a word that I've heard today. When we talk about private market and we talk about alternative credit, we assume that disintermediation, the level of disintermediation will be the same or maybe even like higher. Depends the jurisdiction, of course, but I'm just questioning, like, for credit spreads that are widening, where the market bifurcates, and I've got a question specifically for you, Niels, maybe on like mortgage. Clearly, when you look at, I don't know, like France or in Europe, where this is a market where you've got a lot of banks, when you start to have a fund-driven strategy that you guys have, and you have banks that are trying still to fight for their survival in some ways because they are, Europe specifically, are far more intermediated. At some point, as Wim was saying, like at some point, if you start to say, okay, hey, your investors, look at the public market, it makes no sense to write or to underwrite mortgage books at this level. And obviously, you've got like the traditional bank or the incumbent bank that will fight for their survivals and still originate good credit because this is their industrial, industrial business model. So my question is, in this market, how do we see the disintermediation going for, I would say, traditional consumer assets? And do we feel that there will be a pricing, I would say, cap and not floor this time because of the traditional banks, trying to fight for their market share? Niels.
Yeah, good question. It's interesting. The consumer space is actually more quickly to react to the price adjustment, right? So I moved to the Netherlands 2.5 years ago, and the mortgage rate was half of what you can get now. So it was relatively quick and upward. So the affordability and the purchasing power that we talked about this morning has definitely been affected. But I don't know if the Netherlands is per se unique. It's been much more institutionalized than a lot of parts of other parts of Europe. I think we're 20–30% of institutional money. It's actually a relatively sizable market. It's 800 billion. It renews about 100 billion per annum. And so there's a need for institutional money, and there's a need for bank money. And yes, cost of funds for banks are going up, and that has been reflected in the quicker turnaround on that price adjustment, but also in anticipation of appropriate risk return. And then when we look at spread levels and the current spread levels, and I love the transparency in residential mortgages because you can go to any website and do a quick search and you see all the mortgage providers. But it's
kind
still
of Bloomberg. It's a kind of Bloomberg.
Yeah, we'll use it for valuations as well to look at the rate offerings. But in that sense, the spread premium has been relatively consistent, and I still think that creates an alignment between banks and institutional money to continue to service that market. And I think that there will perhaps be some contraction in annual flows, but there's sufficient capacity to go around for both players. I do think Europe as a whole will see more influence from institutional capital in the residential market because it is a relatively stable space to operate in. You can play in large volumes. It's really good for the underlying books on which behalf we invest. I think the one thing that you touch on is critical, and that's a new development, is kind of pricing caps that are being put into play. And yeah, that's something to be aware of. I don't know how soon or if at all it'll hit the Netherlands. But yeah, for the most part, we're in a good position. I think the other thing that was mentioned as far as sourcing, we used to be part of NN Group, and we source through our affiliate NN Bank, and we still do, and we have a long-term partnership in that. But we also acquired a non-bank, effectively institution then, where we originate ourselves and originate to distribute into our mandates and funds versus holding it on balance sheet. And so even in this space, we're looking at both sides of the coin to originate new business, and we think there's plenty of volume to go around. But yeah, originate to distribute will come into play more across Europe for residential mortgages as well.
Thank you, Niels. And this is something that you observe as well in Munawar, in your day-to-day as well?
Yeah, I think it's interesting because when it comes to assessing value of private credit or alternative credit, it is not just the optical spread or pickup against publics that you achieve. And as Deborah said, there are a lot of things that play. Volume is the other factor, what sizes you can deploy, and also diversification. And we have learned it the hard way post-Brexit, how important it is to be diversified and not focus in one jurisdiction. So these are all the factors due to which you need to look at all these dimensions and not just pricing when it comes to assessing private credit. Does that mean you go in and sort of invest at any level? No. And I think it's very important to have a bit more discipline and consider some macroeconomic themes. There was an example in the panel earlier about a solar panel transaction being priced sub-Italian sovereign debt. Actually, this is very common in private debt market. Do I think it's possible? Absolutely. Why does it happen? It happens because you need to look at who are the providers of capital, how are they incentivized. If you have local banks who do not have access to anything else, or they have targets set up to originate one asset class in one jurisdiction, then it doesn't matter whether the rest of the world is on fire or not. They'll go and invest. So how do you be more disciplined is extremely important in alternative credit. So that's why we do from time to time see repricing of some assets, which is faster than others. I think eventually they all follow, but it takes time. So to give you an example, in UK, we see private placements very closely linked to where corporate bonds are trading. And as soon as these spreads start to widen, we start to see borrowers being completely familiar with what's happening to the markets. They are willing to tap markets at a higher spread. So we continue to see value in that proposition. Same sector, you could change country from UK to France, and you will see different level of sophistication in some cases in certain sectors, and as a result, borrowers might not be willing to change the rates and not even think of the pricing in terms of rates versus spread terms. So these are some of the challenges we do see, and of course, when we see some markets repricing quickly, we have to react and we capture those. Others, as I said, take time, but overall, as I said, it's not just a case of what's your optical value in alternative and private credit. It's a case of also diversification and volumes and building a good optimal book, which does not mean maximize on just one asset class because it just offers you optically higher value.
Interesting, and actually, as a matter of fact, it's obviously it goes through the banking channel, and the banking channel has constraints, limited resources. So coming back to the reg cap transactions, Deborah, do you see I would say the traditional, reg cap that are very much driven by prudential reasons, and then here you'll have, I would say, less of a, I should not say that in front of regulator, but less of, I would say, a risk transfer, transaction, more stable. This is programmatic. But do you see also banks coming in this current environment, trying to effectively to reduce risk positions or actual risk transfer on some assets that it's not a question really on risk-weighted asset, but more in terms of capacity risk. Do you see those transactions coming as well in the market? And how do you see as well the pricing, amongst the two?
Regulatory capital, the way we present it, we say it is to cover unexpected losses. So, and it's funny because every time you have a big crisis in Europe, then US investors tell you, yeah, but this is non-performing. And we say, no, it's performing assets, core assets that the bank wants to keep. But basically the idea is to get capital that has the quality of the equity in an alternative manner, because obviously issuing equities for banks in Europe today is dilutive. There are a number of factors that we see today, and I'm sure obviously you are very well placed within Natixis to see it, that with the new rules of Basel, a number of floors are being introduced. And specifically, obviously, it's not the case for Dutch banks, because yes, I do believe that there is some kind of a Dutch ecosystem with the fact that the funding is not sitting with the banks, which is very different from what we know in other geographies. But in a lot of countries in Europe, mortgages and core mortgages portfolios, they have benefited from ultra favorable local treatment in their regulatory capital, which is now changing with the inclusion of floor levels. So we do see, and we have seen in regulatory capital, a market developing outside of the traditional large cap and SME type of portfolios, going to more like auto loan portfolios, mortgages portfolios. We do expect to see more of that. We like it because we basically do believe, as we said, that this is a way to access diversified portfolios, to the caveat that you can have an underwriting that is long enough that you can do your analysis and select the portfolios you want to get exposed to. So yes, we expect to see more of that. On your question about risk, we also see a lot of prudential deals being done, specifically in the US, more and more deals being done by large US banks to avoid the additional complexity of becoming a systemic institution. So it's a question then of capacity and size. So yes, this is also a theme that is at play. And finally, in terms of pricing, as previously alluded, my belief is that those kind of trades, they make sense for the bank in a range that has varied across cycles between 7 to, let's say, 10, 11, but that we don't really see being much more volatile than those kind of range. We do some repricing upward, and we're happy about that, but there we definitely believe that there is a cap level linked to the fact that at the end of the day, we are not talking about risk that the bank is uncomfortable to take. So the alternative will also always be other type of tier 1 capital and tier 2 capital.
Thank you. Thank you, Deborah. It seems like when I listen to you, that actually the dynamics from, I would say, a flow perspective, that over the recent years, we were more, I would say, steered towards, I would say, primary origination that might slow down a little bit because the world is leveraging and we may take less debt from corporate to household and whatever. But we may see then more flows coming from bank balance sheet, given as well the constraint, so be it for a various set of reasons, which I think it's quite interesting because we see more and more as well funds that are raising capital for those specific, I would say, strategies. And we see, obviously, more and more funds in needs of financing in some shape or form. So we're talking about capital calls or NAV financing. How do you see that in the, I would say, in the prism and spectrum of alternative credit? Munawar, if you want to take this one.
Sure. So I think, first of all, there is a big difference between when it comes to bank's balance sheet and when it comes to insurance balance sheet. And I think this is quite an important factor when it comes to bank deleveraging and co-participation on or regulatory capital trades. So we at Aviva are quite active in ensuring that when there is a regulatory arbitrage, we sort of capitalize on that. So we have been very actively looking at areas where perhaps banks are best when it comes to originating certain assets, but not necessarily natural holder of those assets, where we come in and work with banks. And the way we work with banks is in some cases, there are funding pressures that banks are facing, so we try not to do risk transfer, but we fund. And in other cases, it might be a capital reason where actually risk transfer is required, but not funding, and in which case you can have synthetic risk transfers. And in some cases, you require funding as well as risk transfer, in which case you have a cash risk transfer or novation of position. So quite actively looking at the differences between the two positions. You asked about capital calls, NAV financing. Again, I'll go back to my earlier comment about private, public having similar risk drivers. But what you often find is in order for something to be in public domain, it requires commoditization. It requires rating agencies to catch up, having rating methodologies, investors to catch up, and very quick to react when it comes to investing. And investment markets are always evolving. Needs of clients are evolving. So NAV financing, capital calls are areas where I see this as no different from particularly NAV financing as private ABS. But what you don't have is, the several tranches that you will have in a typical ABS structures. You have mainly senior and MESPs, but really the underlying concept is there is a fund that is trying to lever up returns. With NAV financing, because it naturally does not fit into the public ABS market because of limitations around rating, because of limitations around funding. It's a complex structure. You can have multi-currency lines. This also means you have better risk-adjusted returns. because what you often find is you have a higher credit enhancement in NAV financing structures and better pricing compared to public ABS market. So we like this. We have invested in a number of transactions in this space. And it's very important for us to work with banks because, let's be honest, you cannot be opportunistic, but also set up franchise business in every single asset class, in every single jurisdiction. So it's actually quite a natural fit for us where we work with banks, we assess transactions, we retain the ability to say yes or no to a trade, and we decide to leave the market when we feel it's not good enough from a pricing perspective. Capital calls, again, sort of very similar logic here, funds trying to lever up their returns. What you also have is a recourse to an LP, limited partner in the structure, in which case it becomes a hybrid of corporate risk and a secured investment, because not only you have recourse to LPs, which are traditional financial institutions, you also have security over collateral. So again, the risk assessment is not too different, but we understand why these structures exist in the private market, and we believe they offer really good relative value at this stage.
No, absolutely. And as a matter of fact, we as a bank originate a lot of these facilities, and there is the one question as well is the amount of capital raised by funds is obviously enormous, and effectively at some point banks as well will become constrained as well in terms of capacity, less so in terms of, I would say, prudential treatment here or recap, because it's typically well enhanced and well rated. So Deborah, specifically on cap call, do you see banks coming to you with, I would say, willingness of like managing exposure as well and capacity, which obviously would be another asset class than the traditional ones you see in the recap space? Or
we've seen both. Obviously, we've seen a lot of deals being syndicated, so basically the NAV financing themselves, and I mean it has a place in the balance sheet somewhere. We are very big in cash flow term funding. So we are pretty obsessed with CLOs and private CLOs, but for some asset classes, we do recognize the additional, as you can say, risk return that NAV can provide. Now, yes, we have seen deals on regulatory capital of those transactions. Again, more than a question of risk transfer, it was a question of capacity and size per individual LPs and funds. And again, on our side, for us, it was a way to get an extra diversification, because those portfolios are probably the ones that were the most diversified ever, with the two layers, layers on the LP risk and then on the underlying fund risk that you could not find in the rest of your portfolios.
Niels, we talked about diversification. I think this morning you mentioned as well the fact that obviously your focus on mortgage, Dutch mortgage, but as well that you were going to diversify potentially on jurisdiction-wise in the US, CRE loans. Can you tell us a little bit more in terms of where do you see opportunities away from, let's say, what you do right now, and where in different jurisdictions or different asset classes it may worth, spending a bit of time in current market backdrop?
Yeah. Well, the US we're strategically going to for real estate debt. And Rupert mentioned a bit about this already, and it's a specialism that he covers from BlackRock. But the US has a huge public associated market to real estate debt, but there's a lot of real estate loans as well, and the partners that we have on the bank side continue to originate those, and we'd love to have a piece in those transactions. So we see a big deployment opportunity when we talk about scale and opportunity. But the latest offering, and also talking a bit about bank dislocation and interest level that we made a play on the last couple of years, is in trade finance and receivable lending. And so well over 10 years we've been active in the ECA space. ECA is interesting because it can be counter-cyclical, right? Providing solutions for development in cyclical times to encourage trade and project finance related transactions. And through that experience, we really saw the untapped potential for institutional money to go into trade finance. And you talk about regulatory capital under Basel, under Solvency II. I think it's an ideal momentum for us to take some of that market share in the trillions of capital that's available and put money to work in that segment. So we've been spending a lot of time and energy to build up our team, to build up our expertise and sourcing relationships. And so for us, that's a big play. When you look at price finding, again, also an asset class that is more quickly to react. In COVID, we had really interesting pricing for a longer duration than expected. When we talked about the temporary pause in 2020 on private loans and just general corporate loan transactions, insured trade receivables actually played out quite favorably for us for longer. And we held price positioning well until the end of the year in 2020. So very much an additional spread and overall yield level that we obtained. And at the moment, we continue to be in a price finding exercise for insured trade receivable transactions as well. But the fact that they're 30, 45-day turn and you can do fixed or floating, I think it's an ideal product for this sensitive market environment to go into, and then to take more from banks or to partner with banks on those transactions is a win-win situation for us.
No, absolutely. And when you speak about those, I would say, trade finance or trade receivables, are you targeting those that have, I would say, originated through banks or through platforms? Because we see more and more platforms, like emerging everywhere, to be honest. We, Natixis, financing them on the senior. You can come along us, independent on the capital structure. But how do you see the dynamics of platform?
Yeah, we do both. Pricing from the bank side is a bit thin, so we like to go and diversify. Geographically, so much more than our other solutions. This is a total global offering that we play in. You get diversification through receivable pools from SMEs, mid-cap and large-cap players. It's a
bunch of everything right now on the origination side.
Yeah.
Thank you, Niels. Staying in the US, I've got one question for you, Deborah, with regard to direct lending. You're quite big in that space. We are quite big in that space as well. We see a lot of, I would say, especially right now, the market is very fluid and mature in the US. We have middle market CLOs supporting direct lending. We see as well what we call syndicated loan facilities, so private CLO or private ABS, for lack of better words. What's your view in the market currently? The market has repriced as well, but what's your view in terms of keep deploying capital, credit risk, spreads, risk rewards in this market specifically?
To start with your question about geographies, I think that the European and the US markets are very, very different there. And what we like a lot about the US market is that it is a deep and diversified market. So obviously you do have a compartment that is for smaller loans, and that compartment would be more comparable to what you have in Europe. And only a couple of players in Europe can build truly diversified portfolios beyond 12 to 15 names. So my view is that the risk return of the financing should be reflecting that, which has not always been the case. So if you are taking idiosyncratic risk, you should be paid for idiosyncratic risk, which is why, to be honest, we've been pretty careful on financing the portfolios in Europe, or let's say pretty selective. The US technology, you can go up the ladder to mid-market CLOs or private financing. The good thing about private financing, mid-market private financing, is that because you are privately rated on the underlying assets, you can have early trigger that can prove to be as efficient as the one that you have in CLOs. So this is why for us, both aspects, CLOs mid-market and private financing mid-market could be combined in the portfolios. In Europe, obviously, you don't have mid-market CLOs, so it's only private. And then really it's a question of how you can convince yourself that either you really take a senior financing risk or you are paid enough for what you take.
That's very interesting. I share the same view on this one, definitely. The one thing
We
though
like
is
to co-invest with you.
I know. But in Europe, I mean, this is something which is quite interesting because, to be honest, yes, direct lending, corporate in Europe, less liquid, less, I would say, downside protection. Pricing are super tight. And there's a little bit of frustration there in terms of we discuss, public-private, but even in alternative credit, what we are seeing here is that we're saying direct lending, we go to US, Europe, kind of, it's hard. What's your view in the evolution of this market? Because, we've been saying this market will develop, we'll see potentially middle market CLO emerge or a more mature market. It's super fragmented. It's very difficult to understand what can be the future here. So can you give us a little bit your view on this specific asset?
Sure. I think one thing to bear in mind is that something which is in the public domain does not necessarily mean it's low risk. So it often means it's more liquid, it's more deep, but often the power of investors is somewhat weakened when you have too many other investors for the same product. So this is one thing which I find, you're absolutely right, Deborah, US market, extremely deep, you don't have that equivalent in Europe, but I actually think for private alternative credit, it's actually a good thing. Because what that means is we are able to get better governance, we are able to get lower leverage, and we are able to get better relative value on a more private structure. And that is what we are capitalizing on, because if I speak to someone in US, the natural comparison they will have is, I can go and do this in the public domain, why should I give you this? Whereas in Europe, because that alternative market is not that deep, actually we are able to see really good value. And even in current times, as you know, first of all, public ABS market has very quickly priced. Spreads have widened. If you look at markets for sort of AAA end of last year, we were seeing sort of 70, 80 basis points. We are now at sort of close to 150, 180 basis points spread. So very quick reaction. And again, even at that level, if I compare it with more private NAV financing, capital call facilities, levels look attractive. But as Deborah said, there is more concentration, but I would argue there is also more structural protection, mark-to-market governance, which are extremely rare in US. No CLO manager will ever give you those. In Europe, on a more private structures, it's actually quite common to have governance where you can react early, call early, sell portfolios early. So for all those reasons, we quite like the European market, and particularly, as I said, the private market.
Thank you, Anwar. So it actually leads me to one question, listening to you, is the dynamic management of those alternative credit holdings. We are saying it's buy and hold. As a matter of fact, you are managing those investments for investors. How do you see the management, where it's obviously more liquid with a lot of, I would say, structural features? What's your day-to-day management of those holdings?
Yeah, no, I think that's a very good question. First of all, I think it's very different from the way public markets work. This is why I was saying you often have similar risk drivers, but the approach you apply to private credit is very different from public credit. Right from who do you source assets from is very important. How do you know you are getting the right price for an asset? How do you know you are assessing all the risks? The illiquidity premium is actually pure illiquidity premium, or is not a reflection of some risk premium hidden in the structures. These are all the important factors, and that what differentiate investment managers when it comes to asset selection, because it is not as clear-cut as public markets, where you have a rating, you have a tenor, you have a pricing, and sort of to demonstrate your skill set is very difficult. Here, security selection, origination source, pricing, rating, and it doesn't stop there. Once you have originated an asset, all these structural protections that you often see in private credit, you have got the protection. You need to also monitor them. You need to have a plan which you need to put in action when things go wrong. When somebody approaches you for consent, what's gonna be your approach? How do you ask for sort of some amendments in these structures, so that even if you're waiving certain conditions, you have opportunity to to sort of make sure they sit on the table and discuss how do you force them to delever early in the process. So these are all the good options that sort of comes with private credit, but you need a sophisticated institution to be able to maximize these options that are in your favor when things go wrong. And let's be honest, things have not gone bad so far, but this next few years will be a good test of how you actually use these options embedded in your contracts.
Yeah. Well, my question was not innocent in the sense that exactly we didn't really test it. So I think for me it's where the value of as well managers are. And Deborah, do you share the view of Monaware of Vincent? Can you add anything else on as well the valuation? Not only obviously you need to monitor, you need to be able to negotiate, to amend, to enforce. Hopefully not. But in terms of valuation, how do you come up with valuation to your investors that makes sense, if I may say so?
There is not one answer. Huh? It really depends on asset classes. Our view, again, is that it's a question of balance. I mean, you can't get the liquidity and get a mark-to-market valuation. This is why, for example, there is a concrete example today in the market about, the mortgage structure that have been sold. Those assets, they are obviously liquid, but a lot of the packaging has been done in pooled funds. So if you are in a pooled funds, then you have to value, because some people can get in, some people get out. And even if you don't want to get out, then you are hit by the value if people want to get out. This is a situation that is concretely happening in the market. On those type of assets, and I would perfectly echo what you have said, we always believed that the role that we could provide to our client was about the origination, the partnership, as Wim said previously, the selection, but also the accounting. How basically you reflect in a balance sheet that this should be a true loan and receivables. And then the question of valuation is secondary, because then you are about, long-term valuation, cash flow, impairment, and that's it. So for me, it is really important to have a balance between the way you account, the way you put it in the balance sheet, the way you treat capital if you are a regulated institution like an insurance company, and the way you value. In the direct lending, I don't disagree with what you have said. I was talking about the financing part, which is for me a part where I don't see the benefit of being not systemic in the financing. But then if you are direct in the loan by loan, obviously what the European market brings you is the ability to be tailor-made and to be still covenanted in markets where across the board in the US you would be like light covenanted. So yes. So coming back to your question of valuation, I think that it's really a question of echoing what does the asset do for you in the balance sheet? How do you account for it? Is it a long-term investment, or do you want to hold it as a tradable investment? Then the question is very different.
Thank you, Deborah. I've got one question for you, Niels, as well. I'm thinking of what we discussed on the intermediation and the different assets available, in the universe. And if we say they have enough volume for non-bank and banks, I've got one question on product. Do we feel that, and collectively, that some products will emerge? I'm thinking buy-to-let in the Netherlands, not something which is very, I would say, predominant like in the UK. Second lien, things where maybe banks will be more active in the traditional sense of it, but maybe less so for, the gaps that will still exist in the market. How do you see the emergence of new product, of new markets, or maybe more pronounced than it used to be, like buy-to-let or second lien or whatever?
Yeah, maybe step away from the underlying investments. I think what will change more in Europe, what we haven't experienced, and go back a little bit on the differences between US and Europe, primarily on the direct lending side and corporate loans. In the US, there's a lot of BDC vehicles.
Correct.
And attracting other forms of allocation capital. And I'm a firm believer that the investor should be aligned with the underlying investment. So if it's a buy and hold position, it should be seen as an illiquid asset class. But What will develop, and hopefully quite rapidly still though, is other pockets of source capital besides institutional capital, moving more into the wholesale retail space. And so that's something Europe still needs to explore. I think that creates deeper pockets of opportunity in specific segments. On the convergence of underlying investments, yeah, I think there's lots of areas that I think are interesting, but are not returning enough and are not scalable enough. And again, taking the investor's perspective, European allocators, pension funds, and insurance companies have struggled with fund leverage, and it's very much different in North America or other parts of the world. And so their creative structuring can be done to make the underlying investments more appealing. One area that we've looked at and haven't extended very far is leasing, for example. I think a hugely interesting space. What we struggle with is returns. What we struggle with is the ESG correlation. And if we find solutions to that, I think also a space for us to explore much further. But yeah, I think product innovation will start with attracting more capital in this space to allow the continued deployment in the same segments that we're already active in today.
Thank you, Niels. And just following up on your comments on ESG, I think we discussed ESG throughout this morning, specifically for alternative credit. What assets are more prone to, to be, I would say, ESG? When I say that, it means we discuss the data. We have issues, with the data, just the data, to get the data. So what would you say, Niels, then Deborah, on what are the assets that are more prone to ESG right now? In very specific terms,
Yeah. So first on how we've looked at it, because the comments that were made already today with lack of data, I think is in part true. I think it's also in part, how does the data from private markets correlate to what you would see in public markets, and public markets very much being focused on corporate entities, and there lacks similarity with real assets, for example. So the measurability becomes more difficult. I joined our organization 2.5 years ago and was tasked with, how do we integrate a legacy portfolio? How do you backdate and score a legacy book of hundreds of assets? And so we really needed to develop bespoke scorecards, and across the 5 different investment hives that we have, I think we have 10 different scorecards for ESG. We collected a lot of data. Now with the ESG panel, we talked about PI indicators and SFDR, and how do we change our ESG scorecards to align with those and collect more data. So I agree, we shouldn't have too long of a list, but the list is getting increasingly long in the Q&A that we do for our underlying bars. And again, I appreciate the comment that Natixis will help with some of that as well. But I do think there's buy-in from bars, from partners to score more regularly on all of our transactions, ranging from ABS to residential mortgages. But as far as, and I think this is the point that you're trying to create, right? It's not just about the measurability. It's providing the real impact and finding the correlation between sources and uses. I think is just as important than the measurability. And although there's a lack of data, I think the impact is much greater through private debt, because there's a specific source and use to it than most other parts in the market. And it's right now also very critical to let private markets continue to fuel a positive development on the energy transition and being part of renewable infrastructure and financing that. So we're certainly doing that, but yeah, there's perhaps more of a mismatch between regulation and the actual impact that private debt can achieve. So it's going to be super interesting how it develops. The reason why we have a team that sits together collectively is that there's not enough time in the day to go through all the requirements, but we can share inside knowledge. And how do you get the information from public markets to private corporate loans, and then how do you transition that to real asset components? So a lot to learn, a lot to develop, but again, the message there is look at the impact that the financing is there to achieve. And I think right now, when we talk about price finding and do we halt deployment, vintage diversification is super important. I'm troubled with the fact that even in the Netherlands that they're talking about using more coal. And if the government is not providing support to a positive transition, what can we do in private markets to really stimulate that, invest still today at the right price, but don't stop? I think that's most critical. I think when you start to withdraw, I think it reverses positive trends that we've already seen and achieved. So in a way, I'm trying not to pick my favorite child off all the investment classes that we're in, because I think in some way or another, we have a positive impact across the solutions.
Thank you very much. Deborah, your take on it?
Yeah, I'll try to be quick.
Yeah, no worries.
I would support what has been said. For me, there are two big challenges. One, we try to deploy ESG across the board where we can influence the market, to push the market on the topic of data that we have all discussed. One concrete example, being a huge investor in AAAs of CLOs, we push the market towards exclusion, towards data subscription to one provider, so that you can have level playing field and ability for investors to compare transactions across the board. But to your point, we have done for this year, and this is where I do believe that we can bring the most to the table in impact. We have done our first regulatory capital trade, where in fact, for us in regulatory capital, ESG is three things: the counterparty, the portfolio, but also the impact. How basically the bank is using the money back to finance to areas that matter. And in fact, we have brought to the table the first commercial real estate loan transaction, where in fact the bank will get a small discount if basically the amount of capital is brought back in positive impact loans. So that's, for me, exactly what you were saying, what we try to achieve. On one side, where we are a market taker trying to push for standardization of data, but on the other side, where we are a market maker trying really to create transactions that can have a positive impact on the aspect.
Thank you very much. Very interesting. We could keep on forever, but I see the cocktail outside and the sun, so we won't keep you too much. I think we just finished the session, so I don't know if there is any questions from the audience. I can't see, by the way.
You killed the question, huh? Because
I killed the question.
1 minute.
Yeah, it's the passion, you know, Deborah, you know me. It's like it goes, and so I killed the question. No. But like, if any questions from the audience or online, but I can't see online, so I'm not sure if there are any questions. No. All right. So let's go, and thank you very much, the three of you.
Thank you.
Thank you.